Welcome back to the deep dive. Today we're plunging into a topic that can make anyone's stomach drop. That tax bill you just can't pay all at once. It's a common, stressful situation. But here's the surprising truth. The IRS actually provides clear pathways to manage that outstanding balance. And even better, there are smart strategies embedded within their system that can genuinely save you money on fees and penalties. We're not talking about general tax-saving strategies today, but really how to minimize the costs associated with an outstanding tax debt.
Precisely. This deep dive is all about understanding the IRS installment agreement, specifically Form 9465. It's a critical tool for your financial well-being. It allows you to pay off your tax debt over time rather than facing immediate and often more severe collection actions. And as you mentioned, knowing the nuances can absolutely lead to real savings.
Our mission is to cut through the jargon, break down this form and the process surrounding it piece by piece, and equip you with the knowledge to navigate this, hopefully with fewer headaches and, yes, those surprising savings on associated fees and interest. So let's unpack this financial lifeline. Okay, so the core problem is something many people face, right? You filed your taxes, or maybe you've received a notice from the IRS, and suddenly you realize you owe a significant amount. Your immediate reaction might be panic, that feeling of being overwhelmed. You might think, what now? I don't have that kind of money just sitting around. But what's crucial to understand right off the bat is that there is a structured solution. You are absolutely not alone in this. And the IRS has a formal process specifically designed for situations just like yours.
Exactly. And that structured solution is what we call an installment agreement, or IA for short. At its heart, an installment agreement is a formal payment plan you set up directly with the Internal Revenue Service. It's designed specifically for taxpayers who genuinely cannot pay their full tax liability immediately. Think of it as a lifeline, really. A way to responsibly manage your debt when a lump sum payment simply isn't feasible. And Form 9465 is the specific tool you use to request this monthly installment agreement if you find yourself in that position, whether the amount you owe is from your original tax return or maybe from a notice the IRS sent you later.
And here's a crucial initial consideration, and it's actually suggested by the IRS themselves, right in the instructions for this form. Before you even think about requesting an installment agreement from them, they actually want you to consider other alternatives.
Other alternatives, like what?
Well, things like getting a bank loan, or maybe using available credit you already have.
Why would the IRS suggest that? Seems a bit counterintuitive. Yeah, it does, doesn't it? But the reason is, surprisingly, these alternatives may actually be less costly than an IRS installment agreement. And this is a really important point when we think about minimizing the overall financial impact. You see, the IRS will continue to charge interest and penalties on your outstanding balance until it's paid in full. And those charges can add up significantly over time. So if you can secure a lower interest rate loan from a bank, or maybe manage to pay off the debt quickly using existing credit that carries less interest than the IRS's combined interest and penalties, well, then you could effectively save a significant amount of money. It's an important mindset shift,
Yeah.
Minimizing your associated costs, even if the advice comes from the IRS itself.
So it's really about evaluating all your options to find the cheapest path forward, not just automatically assuming an IRS payment plan is the only way to go. It's about being a savvy consumer, even when you're managing tax debt.
Precisely, being strategic. And speaking of PABs, it's also important to know who this Form 9465 is specifically designed for, because it's not for every single tax situation. You should use this form if you're an individual owing income tax, like what you'd report on a Form 1040 or 1040 SR. It's also for individuals who find themselves responsible for something called a trust fund recovery penalty. Another specific group is individuals who owe employment taxes, think Forms 941, 943, or 940, but, and this is key, only if that business is a sole proprietorship and it's no longer operating, defunct. Lastly, it was also used by individuals who owed an individual shared responsibility payment under the Affordable Care Act, though that specific payment isn't assessed anymore for months after December 31st, 2018.
Okay, so it's really tailored for a specific set of circumstances, which must mean there are situations where you shouldn't use this form, right? And perhaps where you can save even more money by choosing a different route.
Absolutely. There are clear scenarios where Form 9465 is not the right tool, and choosing an alternative can significantly reduce your costs. For instance, if you think you'll be able to pay the full amount you owe within 180 days.
6 months, basically.
Right, 6 months. You shouldn't use this form. In that situation, you're eligible for what's called a short-term payment plan. And the huge benefit here is that you can avoid the installment agreement user fee entirely. That's a direct financial saving right there.
And we'll get into those fees later, I assume. They can add up.
Oh, definitely. We'll break those down. Also, if you want to request a payment plan online, which, as we'll see, almost always comes with a significantly lower user fee, you should use that online method instead of mailing in Form 9465. And critically, if your business is still operating and owes employment or unemployment taxes, you should not use this form.
Okay, so ongoing businesses with payroll tax issues need a different approach.
Exactly. The IRS instructs you to call them directly using the phone number on your most recent notice in that case. The distinction is important because employment tax issues for ongoing businesses often have different complexities and, frankly, require more direct communication. Choosing the correct path right from the start can save you both time and money.
So it's really about guiding you towards the right path based on your specific situation and even, like you said, your ability to pay sooner. It seems like there are already built-in ways to minimize costs even before you start filling out any forms.
What's truly fascinating here is that the form itself, right there on its very first page, gives you clues on how to potentially save money on fees, even before you start filling it out. This is where being well-informed truly pays off. The prime alternative to filing Form 9465 is something called the Online Payment Agreement, or OPA. The IRS even highlights it as a tip directly on the form instructions. You can access it easily at irs.gov/vivo-PA.
OPA. Got it. irs.gov/vivo-PA.
Yep. And the eligibility for using the OPA is quite broad. If you owe $50,000 or less, and that includes amounts from prior years too, you can likely use the online application. The key advantage, and this is a direct saving on administrative costs, is that if you set up your installment agreement using the OPA application, the user fee you pay will be lower than if you file Form 9465. Significantly lower in some cases. It's a big incentive to go digital if you qualify. And you can even apply through OPA before you've received an official tax bill or notice.
This next point is truly eye-opening, especially for anyone looking to minimize costs. Just by understanding the options before you even fill out a form, you could be looking at significant savings. I mean, imagine saving over $100, not by changing your tax debt itself, but simply by choosing the right way to apply for a payment plan. That's real money staying in your pocket, just by picking the most efficient application method.
Absolutely. And building on that, there's also that short-term payment plan we mentioned, allows you up to 180 days to pay your full tax liability. The benefit here is huge. You can avoid paying the fee to set up an installment agreement entirely.
Zero fee. That's the best kind of fee.
Exactly. If you know you can pay within that 6-month time frame, this is clearly the most cost-effective approach. You can arrange this by calling the IRS directly at 800-829-1240, or if you owe $100,000 or less, you can also use that same OPA application we talked about, irs.gov OPA.
So it's all about being well-informed and picking the right tool for your situation. Knowing these upfront choices can genuinely save you money. It shifts the mindset from just, how do I pay, to how do I pay most efficiently and cost effectively. It's almost like the IRS is offering a discount code if you just know where to look.
That's a great analogy. It really is about being strategic. Now, it's important to understand that not all installment agreements are created equal. The IRS has different categories, right? Each with its own criteria and implications. These distinctions are primarily focused on your ability to pay and, of course, the amount you actually owe. Let's break down the 3 main types and sort of how they relate to the level of financial scrutiny the IRS will apply. First up, we have the Guaranteed Installment Agreement.
Guaranteed sounds good.
It does, and it's typically the most straightforward to get approved for, but it comes with pretty strict eligibility rules. The tax you owe must not be more than $10,000. That's the first hurdle. In addition to that financial cap, you and your spouse, if you file jointly, must have timely filed all your income tax returns for the past 5 tax years. Clean record there. You also can't have entered into another guaranteed installment agreement in those same 5 years, so it's not something you can use repeatedly in short order. Furthermore, you must agree to pay the full amount owed within 3 years. That's a relatively short time frame. And you have to agree to comply with all tax laws while the agreement is active. Stay current, basically. And crucially, you must genuinely be financially unable to pay the liability in full when it's due. They still need that justification, the main benefit. Generally, fewer requirements for approval, making it simpler if you tick all those boxes.
Okay, so the Guaranteed IA is like a fast pass for smaller, clear debts if you have a perfect recent track record. But what if you've got a larger tax bill, say $30,000? Or maybe you missed filing a return a few years back. Does the IRS still offer a realistic path, or are you in a much tougher spot?
That brings us neatly to the streamlined installment agreement, which is probably the most common type people encounter. Generally, you're eligible for a streamlined agreement if your assessed tax liability is $25,000 or less. This applies to individuals, certain businesses with only income tax debt, or out-of-business taxpayers. Now, here's a key incentive from the IRS. They've actually expanded the eligibility. If your assessed tax liability is between $25,001 and $50,000 for an individual or an out-of-business sole proprietorship, you can still qualify for a streamlined agreement if you agree to pay by direct debit or payroll deduction.
So they really want those automated payments for the slightly higher amounts in this category.
They absolutely do. It's a significant point because choosing direct debit or payroll deduction in this range can save you from a much deeper financial review. Now, for a streamlined agreement, your proposed payment amount must pay the full assessed tax liability within 72 months.
That's 6 years.
6 years, right. Or by the collection statute expiration date, the CSED, whichever date comes first.
Okay, and you mentioned CSED before. Remind us what exactly that is.
Right. The CSED collection statute expiration date is normally 10 years from the date the tax was assessed by the IRS. However, that 10-year clock can be paused or extended for various reasons, like if you file for bankruptcy or submit an offer in compromise. For the nitty-gritty details on how the CSED works, the IRS points you to irs.gov/time-rs can collect tax. But the key benefit of a streamlined installment agreement, and this is a big one, is that generally it does not require a financial statement. That's Form 433-F we'll talk about later.
Yeah.
And usually it doesn't trigger the filing of a notice of federal tax line or an FTL.
Okay, so less paperwork for you and less impact on your credit, potentially, since those Lorians can show up on credit reports. That sounds like a major advantage.
It really is. It simplifies the process considerably for a lot of taxpayers.
So the streamlined option sounds like the most common, less intrusive path, especially if you can commit to that direct debit. That makes sense. They want consistent, automated payments. But what if you truly can't even manage to pay off the full amount within that 72-month time frame or before the CSED hits? What happens then?
That's when you're looking at the third type, a partial payment installment agreement, or PPIA. This type of agreement is specifically for situations where your proposed monthly payments, even if made consistently, will not pay the full balance owed before the CSED.
So the IRS essentially agrees they might not get the whole amount back before the collection time runs out.
Essentially, yes. And because this is a more significant concession from the IRS, it naturally comes with more stringent requirements. With a PPIA, you will be required to complete a financial statement, that Form 433-F, and provide supporting financial documentation, bank statements, pay stubs, things like that. It's a much more intrusive process because the IRS needs to verify your inability to pay in full. They really need to understand your complete financial picture. They want to ensure that the partial payment you're proposing is genuinely all you can afford. Furthermore, if a PPIA is approved, your agreement isn't just set and forget, it's subject to future reviews, usually every couple of years. They'll check if your financial situation has improved. You might be asked for new financial statements, and based on that review, your monthly payment could potentially be reduced, increased, or it might just stay the same.
So the PPIA really signals a deeper financial challenge, requiring more ongoing engagement and scrutiny from the IRS. It feels quite different from the streamlined option. It's almost like the IRS becomes your, financial check-in partner, really digging into your budget regularly.
That's a pretty good way to put it. And this raises that important question. Why the different tiers? Why the scaling scrutiny? It really boils down to balancing the government's need to collect taxes with a taxpayer's genuine inability to pay. The more you owe or the longer you need to pay, the more information the IRS logically requires to ensure the agreement is viable and fair for both sides. They need to ascertain that you are paying what you can reasonably afford based on your verified finances. And they need to ensure the agreement actually serves its purpose of resolving the debt in some way. It's a risk assessment for them, essentially. The more risk they perceive, meaning less likelihood of full payment, the more information they need to protect the government's interest while still offering a path forward.
Right. Now that we understand the different types of agreements and how they kind of scale with your debt and your ability to pay, the next logical step is to turn our attention to the form itself, Form 9465. How do we translate this understanding into actually filling it out effectively? And where are the crucial points that determine your outcome and, importantly, those potential savings? We won't read it line by line like an instruction manual, don't worry, but let's highlight the crucial sections where your choices make a real difference, starting with identifying yourself and the tax debt.
Exactly. We'll start with part 1, Installment agreement, request your proposal. This is where you tell the IRS who you are, what debt you're talking about, and what you're proposing to pay. The first few sections are pretty straightforward. At the very top, you'll state which tax forms like Form 1040 and the specific tax years or periods your debt relates to. Clear identification. Then you'll provide your basic personal information. Name, social security number, current address. Standard stuff. If you filed jointly, remember to include your spouse's name and SSN in the same order as on your tax return. Consistency matters. If your address is new since your last return, there's a simple box to check. Make sure they can find you. And if you're applying for a defunct business, a business that's no longer operating, you'll include its name and employer identification number, EIN, here together. Finally, you'll provide contact phone numbers home and work and the best time for the IRS to potentially call you if they have questions. These details just ensure the IRS can accurately identify you and communicate effectively about your request. Pretty simple so far.
Okay, makes sense. Then we get into the numbers, calculating your amount owed. This is where you lay out the full scope of your tax liability. And you mentioned there's a key opportunity for maybe indirect savings here.
Absolutely. On line 5, you'll enter the total amount you owe as shown on your tax returns or any notices you've received from the IRS. This can include amounts from multiple tax years if needed. But line 6 is a really crucial detail that many might overlook. This is where you enter any additional balances due that are not already reflected on line 5.
Additional balances, like what?
Could be amounts from other tax periods you know about but haven't been billed for yet, or maybe adjustments you know are coming. Even if they're already part of an existing, maybe different installment agreement, you list the total here. Ensuring you list everything here gives the IRS a complete picture up front and helps prevent future complications or surprises down the road. Then, line 7 is simple math. You just add lines 5 and 6 to get your total tax liability. Now, line 8. This one is extremely important for minimizing your total cost over time. It asks for any payment you are making with this request.
The upfront payment.
Exactly. Even if you can't pay the full amount you owe right now, which is why you're filing this form, you should pay as much as possible up front with this request.
Why is that so important?
Because interest and penalty charges continue to stack up on your outstanding balance every single day until it's paid in full. It doesn't stop just because you asked for a payment plan. By reducing that principal balance right away with the payment on line 8, you directly limit those ongoing charges. It's a straightforward way to save money over the life of your agreement. If you're filing Form 9465 with your tax return, you just make this payment along with your return as you normally would. If you're filing Form 9465 by itself, say, in response to a notice, you should attach a check or money order. Make it payable to the U.S. Treasury. And be sure to include your name, address, SSN or EIN, daytime phone number, the tax year, and the tax return form, like 2023 Form 1040, right on the check or money order. Details matter. Then line 9 is just your total owed from line 7 minus your initial payment from line 8. This is the actual amount your installment agreement will cover.
Got it. So paying as much as you can upfront on line 8 is a direct smart move to save on those compounding costs. It's a proactive step that pays off immediately. Makes perfect sense. Now, how do you actually propose your monthly payment to the IRS? What's the process there?
That happens on lines 10, 11A, and 11B. This is where you'll determine your monthly payment proposal. Line 10 is a quick calculation the IRS asks you to do. You take the amount on line 9, the amount you need to pay off, and divide it by 72.0.
Divide by 72. Why 72?
Good question. 72 months is 6 years, which is the maximum time frame allowed for many streamlined installment agreements to pay off the debt. So this calculation gives you and the IRS a baseline monthly payment, a benchmark figure that would clear your debt within that standard time frame. Then on line 11A, you enter the amount you can realistically pay each month. And the instructions here specifically emphasize, make your payment as large as possible to limit interest and penalty charges.
There it is again. Pay more if you can.
Exactly. It reiterates that same cost-saving principle. If you don't propose an amount on 11A, the IRS will typically calculate one for you, often using that 72-month benchmark from line 10. Now, line 11B is only used if your proposed payment on line 11A is less than the line 10 benchmark amount, and you realize after thinking about it, okay, maybe I can increase it a bit. If so, you'd enter your revised higher monthly payment amount on line 11B. And this section right around line 11 is absolutely critical because it leads directly into the crucial Form 433F decision.
It's a financial statement decision.
Okay. Right. Think of it as a sliding scale of IRS scrutiny. Your answers here determine whether you'll need to submit that detailed financial statement, Form 433F. Let's simplify this into 3 key scenarios. Scenario 1, deep dive required. If your proposed monthly payment, either on 11A or 11B, is less than that line 10 benchmark amount, and you genuinely cannot increase it to meet or exceed that benchmark, then you must check the box located just below line 11B. Checking that box signals to the IRS, my proposed payment is below your standard benchmark and I can't raise it. And because of that, you must also complete and attach Form 433F. They need to see your full financial picture to justify that lower payment. Scenario 2. Streamlined path to no Form 433F. Now, here's the incentive path. If your total amount owed from line 9 is over $25,000 but not more than $50,000, and your proposed payment on line 11A or 11B is more than or equal to the benchmark amount on line 10, then you get a significant break. You don't have to complete Form 433F.
Oh, okay. So meeting that benchmark payment avoids the extra paperwork in that debt range.
Exactly. But there's a condition, a catch, if you will. To avoid submitting Form 433F in this scenario, you must commit to using either direct debit on line 13 or payroll deduction on line 14 for your payments.
So they trade less paperwork for guaranteed automated payments.
Precisely. It's a very strong incentive from the IRS. They get reliable payments. You avoid the hassle of the detailed financial statement. Scenario 3. Full disclosure. Always. This one's simple. If the amount you owe on line 9 is greater than $50,000, it doesn't matter what your proposed monthly payment is. You must always complete and attach Form 433F. It's a hard rule for higher debt amounts, no exceptions there based on payment method. And there's one more wrinkle, a special case, if you defaulted on a previous installment agreement within the past 12 months. And D, you owe more than $25,000 but not more than $50,000. And D, your proposed payment on 11A or 11B is less than the line 10 benchmark. Then, instead of Form 433F, you must complete Part 2 on page 2 of Form 9465. It's a sort of intermediate financial disclosure.
Okay, that's incredibly practical, if a bit complex with the different paths. But the biggest takeaway here really seems to be that your choices on line 11, your proposed payment, and line 13, direct debit, can significantly impact whether you need to disclose a lot more financial information to the IRS. The IRS is basically saying if you commit to consistent higher payments, especially via direct debit, we won't dig quite as deep into your finances, at least in that middle debt range. That's a huge time and privacy saving for you, potentially.
Absolutely. It's a clear strategic choice presented right there on the form. Moving on, line 12 is straightforward. It allows you to choose the day of the month you want to make your payment. You can pick any day from the 1st to the 28th. The IRS will confirm your first payment due date once your agreement is approved. This flexibility can be really helpful for aligning payments with your paycheck cycle, for instance.
Makes sense. Now, lines 13A, 13B, and 13C. These cover your payment method, specifically direct debit, which, as we've discussed, is often the most cost-effective and encouraged option.
That's right. The IRS highly recommends direct debit. They call it the most convenient way, and importantly, note that it will ensure that they are made on time. And that on-time part is critical because, as we'll discuss later, timely payments are essential to avoid defaulting on your agreement, which can have severe consequences. To set up direct debit, you'll provide your bank's routing number on line 13A and your account number on line 13B.
Seems simple enough, but accuracy must be key here.
Oh, absolutely. Double-checking these numbers is crucial. The routing number must be 9 digits, starting with specific prefixes 0112 or 2132. The IRS instructions even provide a sample check visual to help you locate the numbers. They emphasize verifying the routing number with your bank, as it might differ from what's printed on your checks sometimes. Your account number can be up to 17 characters. Just enter it carefully, left to right, including hyphens but omitting spaces or special symbols. Don't include the check number, get these details wrong, and your payment could fail, potentially delaying your agreement or even causing you to miss out on those lower user fees and benefits. Accuracy is paramount. And here's another key saving point, especially for those with lower incomes found on line 13C. This is specifically for low-income taxpayers. If you qualify as a low-income taxpayer and you find you are unable to make electronic payments via direct debit, maybe you don't have a bank account, or direct debit just isn't feasible for some reason, then you check this box, line 13C, instead of providing your banking info on 13A and 13B. If you check this box as a qualifying low-income taxpayer, the user fee you pay for the installment agreement will be reimbursed upon completion of your installment agreement.
So they still get the fee back eventually, even without direct debit, if they're low income. That's a great provision.
It is. It provides a crucial option for those who cannot utilize direct debit, but still qualify for financial assistance with the setup fees.
That's fantastic. Ensures that administrative cost doesn't become another barrier to managing the debt.
Exactly. Finally, line 14 offers the other automated payment option, payroll deduction. If you prefer to have your employer deduct the payments directly from your paycheck, you check this box. But note, you must also attach a separate, completed, and signed form, Form 2159, the payroll deduction agreement, and your employer will need to complete their portion of that Form 2159 as well, so it requires their cooperation. And then at the very bottom of Part 1, you'll find the signature lines. Your signature and the date are required. Critically, if it's a joint return, both spouses must sign. One signature isn't enough. By signing and submitting this form, you're giving the IRS permission to contact third parties if necessary and disclose your tax information to them, but only for the purpose of processing your request and administering the agreement over its lifetime. You're also formally agreeing to the terms of this installment agreement if the IRS approves it.
Okay, that's a really thorough breakdown for Part 1, which seems like it covers the vast majority of what most people will need to fill out. And again, the big takeaway seems to be that the choices you make around that monthly payment amount, line 11, and how you pay, especially direct debit, line 13, can significantly impact not only your fees, but also whether you need to disclose a whole lot more detailed financial information. That can save you a lot of time and hassle.
Absolutely. Those are the key strategic decision points in Part 1. Now let's briefly touch on Part 2. Additional information, the deeper financial dive. As the name suggests, this part is only required under very specific, slightly higher risk conditions we outlined earlier. Completing Part 2 signals to the IRS that they need a much more detailed picture of your financial situation before they can approve your installment agreement request.
Right, this wasn't for everyone. Remind us when exactly this Part 2 is required.
Okay, so all three of these conditions must apply to you for Part 2 to be required. 1. You defaulted on a previous installment agreement within the past 12 months. So there's a recent history of payment issues. 2. You owe more than $25,000 but not more than $50,000 based on that line 9 calculation in Part 1. And 3. The amount you propose to pay each month on line 11A or 11B is less than the benchmark amount calculated on line 10, that 172nd of your debt figure.
Okay, so prior default, debt in the $25K, $50K range, and a proposed payment below the standard benchmark. All three trigger Part 2.
Correct. All three must be true. And it's important to remember, if you owe more than $50,000, you actually skip Part 2 altogether. You go straight to needing Form 433F, the full collection information statement, instead. Part 2 is specifically designed for that quite narrow band of debt, $25K, $50K, when there's both a prior default and a proposed payment that falls below the IRS's standard 72-month benchmark.
Got it. So this section is really for those specific scenarios where the IRS needs to take a closer look because there are maybe a few more red flags, so to speak. What kind of details do they actually ask for here in Part 2? Is it as intense as Form 433F?
It's less intense than the full Form 433F, but it definitely asks for more granular financial and household information than Part 1. For example, on lines 15 through 18, they gather household information. This includes things like the county where you primarily live, your marital status, and importantly, if you share household expenses with your spouse. They also ask for the number of dependents you'll claim this year and the number of people living in your household who are 65 or older. This helps them understand your household's basic size and potential dependency-related costs. Then, on lines 19 through 22, they delve into your income details. You'll need to specify how often you get paid, weekly, biweekly, monthly, etc., and your net income per pay period, essentially, your take-home pay after deductions. And for married individuals, lines 21 and 22 about your spouse's income are particularly important. You must complete these lines regarding your spouse's income if you are married in either. 1, you live with and share household expenses with your spouse. Even if only one of you owes the taxes, the IRS considers total household income and expenses relevant to your ability to pay. Or 2, you live in a community property state where the law might factor in the non-liable spouse's income when determining ability to pay. This applies whether you filed jointly or separately.
Okay, that makes sense. It's not just about your individual income if you're part of a shared household economy. They need the full picture of the household's financial capacity.
Exactly. They want the full picture. And finally, on lines 23 through 27, they request specific expense details. This includes things like the number of vehicles you own or lease, how many car payments you have each month. They ask about your health insurance status, and if your premiums aren't deducted from your paycheck, how much those monthly premiums cost you. They also ask about any court-ordered payments you make, like alimony or child support, and the monthly amount if it's not automatically deducted from your paycheck. Lastly, you'll list your average monthly child or dependent care payments, but specifically not including any court-ordered support payments you already listed. So it's a snapshot of some major income and expense categories.
Right. And why does the IRS need this level of detail in these specific cases? What are they trying to figure out?
It really all comes back to determining your true current ability to pay. They're trying to understand your full financial capacity beyond just the simple numbers in Part 1. They need to ensure that the payment plan you're proposing, especially since it's below their benchmark and follows a prior default, is genuinely realistic for your situation. They want to be sure that you're not, trying to avoid paying what you legitimately can afford, but rather that the plan reflects what you can afford based on these additional details. It helps them assess the likelihood of the agreement succeeding and ensures fairness in the collection process.
Okay, that clarifies part 2. Now let's talk about the broader financial picture. Beyond just the tax you owe, we know there are other costs involved with an installment agreement, like those user fees and ongoing interest. But you've also hinted that knowing the rules can lead to some smart savings that many people might not be aware of. Let's break down these costs and, crucially, how to minimize them.
Yes, let's. One of the most direct upfront costs is the installment agreement user fee. The IRS charges this fee just to set up an IA, and the amount varies quite significantly based on how you apply online versus paper and how you propose to make your monthly payments direct debit versus check, etc. These fee amounts were updated and are effective as of July 1st, 2024, so these are the current rates we're discussing.
And you said earlier the differences can be huge, like really substantial.
Oh, absolutely. What's truly fascinating here is the massive difference in fees. Opting for the online direct debit option over, say, the paper form paid by check could literally save you well over $100 in fees alone.
Wow, that's a real tangible saving that comes just from knowing your options and choosing the most efficient path up front. That's amazing.
It really is. Let's look at the numbers. If you establish your agreement using the online payment application, OPA, at irs.gov OPA, if you opt for direct debit, the user fee is only $22, super low. If you choose to pay by check, money order, or credit debit card but still apply online through the OPA, it's still a reduced fee of $69. Now, compare that to not using the online payment application, meaning you're mailing in Form 9465. If you choose direct debit on the paper form, the fee jumps up significantly to $107.
So same payment method, direct debit, but applying online saves you $85 right there. $107 to $22.
Exactly. And if you plan to pay by check, money order, or credit debit card using the paper form 9465, the fee is the highest at $178. Similarly, if you choose payroll deduction using Form 2159, your user fee will also be $178 unless you qualify as a low-income taxpayer. There's also a small fee, $10, if you need to reinstate or restructure an existing installment agreement, but only if you do it through the OPA. The fee structure clearly shows the IRS's strong preference for online applications and automated payments, and they directly reward you financially for using those methods.
Those fee differences are incredibly stark. It's a very clear incentive to use the online portal and set up direct debit if you possibly can. Huge savings. But what about taxpayers with lower incomes? We touched on this with line 13C, but are there broader benefits for them regarding these fees?
Yes, this is where significant savings can occur for low-income taxpayers. It's really important. First, the definition. A low-income taxpayer, for this purpose, is generally someone whose adjusted gross income, AGI, from their most recent available tax year, is at or below 250% of the federal poverty guidelines for their family size. The instructions for Form 13844, which is the application for reduced user fee, provide details on how to determine if you meet this threshold. Now, if you are a low-income taxpayer, there are distinct fee waivers and reimbursements available, the best deal. If you qualify as low income and you agree to make electronic payments through a direct debit installment agreement, DDIA, meaning you provide your banking info on lines 13A, 13B of Form 9465, the IRS will waive the user fee entirely.
Completely waived, so zero setup fee.
Zero setup fee. This is, without a doubt, the best option for qualifying low-income taxpayers. It removes that cost barrier completely. Now, what if you're low income, but you can't use direct debit? Maybe you don't have a bank account, or it's just not feasible. That's where checking box 13C comes in. If you're low income and check box 13C because you're unable to make electronic payments, you will initially pay a reduced user fee of $43. However, the IRS will then reimburse that $43 fee back to you upon completion of your installment agreement.
So you pay it up front, but you get it back when you finish paying off the tax debt. Still a great benefit.
Absolutely. You eventually get the money back, and if the IRS doesn't automatically flag you as qualifying for low-income status based on their records, you can proactively request consideration by filing that Form 13844, Application for Reduced User Fee for Installment Agreements. This ensures everyone eligible has a clear path to these fee reductions or waivers.
That's incredibly helpful and fair. It shows the system has provisions to ensure these administrative costs don't disproportionately burden those with limited financial means.
Yeah.
Good to know.
Definitely. Now, beyond the user fees, there are those other costs, interest and penalties. And this is a crucial point that really bears repeating. You will be charged interest and potentially a late payment penalty on any tax not paid by its original due date. Even if your request to pay in installments is granted, the clock on interest and penalties doesn't start.
Right, so the installment agreement gives you breathing room on the payment schedule, but it doesn't freeze the accumulating costs.
Exactly. Those charges will continue to accrue day after day until the full balance is paid off. So while an installment agreement is a valuable tool, it's not a free pass on the ongoing accumulation of these costs. The faster you manage to pay down that principal balance, the less interest and fewer penalties you'll ultimately incur over the life of the agreement. It's also worth noting a specific detail regarding the old Shared Responsibility Payment, or SRP, under the Affordable Care Act for months before December 31st, 2018. While interest will continue to accrue on any unpaid SRP amount, that specific payment is not subject to penalties or to more aggressive collection actions like a notice of federal tax in lien or levy. However, any federal tax refunds you are due can still be applied to offset that SRP amount owed.
Okay, so this really highlights a critical cost-saving strategy then, doesn't it? Make your payments as large as you possibly can right from the start and throughout the agreement. The faster you pay off the principal balance, the less you'll pay in total interest and penalties over the long run. It directly translates into saving money.
Exactly. That's the most fundamental cost-saving strategy when dealing with tax debt. Every dollar you can pay above the minimum required monthly payment directly reduces the base on which future interest and penalties are calculated. It accelerates your path to becoming debt-free and significantly minimizes the total amount you end up paying to the IRS.
Right. Okay, so you've navigated the form, you've submitted your request, maybe paid that initial amount, and hopefully set up the most cost-effective payment method. You've understood the potential costs and savings. Now, what happens next? What's the IRS's role once they receive your request? And perhaps more importantly, what are your ongoing responsibilities and rights within this agreement? This next phase is about what happens after you click send or drop that envelope in the mail.
Good questions. Let's talk about the approval process first. Typically, the IRS aims to let you know whether your request for an installment agreement is approved or denied within 30 days of receiving it.
30 days. That's relatively quick.
Usually, yes. There's an exception, though. If your request is for tax due on a return that you filed after March 31st, it might take the IRS a bit longer than 30 days to process everything and reply. Just something to be aware of. If your request is approved, the IRS will send you a notice. This notice will detail the specific terms of your agreement, things like your exact monthly payment amount, your monthly due date, and it will also formally request the user fee we discussed earlier if one applies to your situation and wasn't waived. So, how the agreement works post-approval. By approving your request, the IRS is essentially agreeing to let you pay the tax you owe in those monthly installments instead of demanding immediate full payment. It's a formal arrangement. In return for this flexibility, though, you take on significant obligations. You're agreeing to several key things by entering this agreement. First and foremost, you must make your monthly payments on time, every month. This is absolutely paramount. Missed or late payments can lead straight to default. Second, you also agree to meet all your future tax obligations. What does this mean in practice?
Keeping up with current taxes while paying off the old debt.
Exactly. It means you must ensure you have enough tax withheld from your paychecks, or that you make sufficient estimated tax payments throughout the year, so that your tax obligation for future years is paid in full when it's due. No new tax debts accumulating. And crucially, you must also timely file all your future tax returns. If you stop filing required tax returns, your installment agreement request could be denied, or an existing agreement could be terminated. And finally, especially if you have one of those partial payment installment agreements, PPIAs, you agree to provide updated financial information when the IRS requests it, typically every couple of years for those reviews we mentioned.
Okay, that sounds like a clear set of responsibilities. It's definitely not a one-time fix. It's an ongoing commitment to financial compliance with the IRS. It really is almost like a financial contract where both sides have very clear expectations and duties.
Indeed. It's a formal agreement, a partnership in resolving the debt, essentially. And something important to note regarding refunds while you're in an agreement: any federal tax refund you were due while you still owe money under the agreement will generally be automatically applied by the IRS against the amount you owe. They'll keep the refund to pay down your debt faster.
Ah, okay. So don't count on getting that refund check in the mail if you have an active installment agreement.
Correct. And importantly, you are still required to make your regular scheduled monthly payment, even if a recent refund has significantly reduced your overall balance. The agreement terms remain in effect.
Good to know. Now, the flip side. What happens if you don't meet those obligations? What are the consequences of non-compliance or default?
Well, if you don't make your required monthly payments on time, or if you fail to timely pay a tax balance due on a future tax return you file, or if you provide materially incomplete or inaccurate financial information when requested, then your installment agreement may be terminated by the IRS.
Terminated. That sounds serious. What happens then?
It is serious. Before the IRS officially terminates the agreement, you usually have the right to an appeal under something called the Collection Appeals Program, or CAFP. You get a chance to argue your case. However, if the agreement is ultimately terminated, the IRS may then take more aggressive enforcement actions to collect the entire remaining amount you owe. This could include filing a Notice of Federal Tax Lien, NFTL, against your property, which can negatively impact your credit score and make it harder to sell property or get loans. Or they could issue an IRS levy, which allows them to legally seize assets, like money from your bank account, or garnish a portion of your wages directly from your employer. The gloves can come off, so to speak.
Yikes. Okay, this really underlines the critical importance of sticking to the plan once it's approved, making those payments on time, staying current on future taxes, and using direct debit, as we discussed earlier, seems like a really valuable safeguard against accidental missed payments, making sure you stay compliant without having to think about it each month.
Exactly. Direct debit removes the human error element, the oops, I forgot factor. It keeps you on track automatically. And just to reiterate a point from earlier about those lynchings, while notice of federal tax lynchings are generally not filed automatically for guaranteed or streamlined installment agreements, they can still be filed in certain situations, especially if you default on the terms of your agreement. Defaulting changes the game. However, it's worth remembering that an NFTL specifically will not be filed just for owing the individual shared responsibility payment under the old Affordable Care Act rules.
Right. But even when you're in a potentially tough spot with the IRS, maybe facing default or other issues, you still have substantial taxpayer rights and appeals. It's not just a one-sided street where the IRS makes all the rules and you have no recourse, right?
That's absolutely true. The Taxpayer Bill of Rights provides significant protections. You have several specific avenues for recourse and appeal. We mentioned the Collection Appeals Program, CAP. This allows you to appeal certain collection actions. You can use CAP to appeal before an installment agreement is actually terminated, giving you a chance to save it. You can also use CAP to appeal before and after a notice of federal tax lien is filed. Then there's collection due process, CDP. This gives you the right to a formal hearing regarding an NFTL filing, but it's typically only for the very first NFTL filing for the specific unpaid tax liability shown on that notice. You get one main shot at that formal CDP appeal for a particular lien. Furthermore, if an NFTL has been filed against your property, you might be able to get it withdrawn later if you meet certain qualifications, like getting back into compliance with an agreement. The IRS website, specifically the section on understanding federal tax liens, and you can search understanding federal tax lien on irs.gov, provides more information on lien withdrawals. And for a broader understanding of the entire collection process and your rights throughout, the IRS provides publication 594 titled The IRS Collection Process. It's a very useful resource.
Okay, lots of specific rights and processes, but what if you feel like you're just hitting a wall? You've tried talking to the regular IRS channels, maybe things are getting complicated, and you need independent help. It sounds like you're not completely alone if you feel overwhelmed or that the system isn't working fairly for you.
That's exactly where the Taxpayer Advocate Service, or TAS, comes in. This is a really important resource. TAS is an independent organization within the IRS. Their sole job is to help taxpayers navigate the system and protect taxpayer rights. Their goal is to ensure that every single taxpayer is treated fairly and that they understand and receive their rights under the Taxpayer Bill of Rights.
Independent within the IRS, how does that work?
It means they have their own reporting structure and can advocate on behalf of taxpayers directly with other parts of the IRS, often cutting through red tape. You should definitely contact TAS if your tax problem is causing you significant financial difficulty, or if you've tried repeatedly to resolve your issue directly with the IRS main channels and have been unable to get it resolved, or even if you believe an IRS system, process, or procedure just isn't working the way it should and is causing problems for taxpayers generally. And the key takeaway here is that this service, TAS, is completely free to taxpayers.
Free help from within the IRS system itself. That's fantastic. How do you reach them?
You can find your local taxpayer advocate's office number and contact information online at taxpayeradvocate.irs.gov, contact US. Or you can call their toll-free number directly at 877-777-4778. It's a vital resource for anyone struggling to navigate these often complex and stressful tax issues.
That's really empowering to know that even when you're in a tough spot with the IRS, facing tax debt and navigating these agreements, you still have substantial rights, appeal processes, and even independent resources like the Taxpayer Advocate Service ready to help you navigate it. It really helps shift the dynamic, even in what can feel like a very disempowering situation.
Absolutely. Knowledge of your rights is power. Okay, so after meticulously preparing your Form 9465, understanding all the nuances, making those strategic choices, the final, seemingly simple but absolutely crucial step is to send it to the correct mailing address.
The logistics.
Yeah.
Don't mess up the mailing address.
Exactly. Getting this wrong can significantly delay your request. And delays mean more accrued interest and penalties potentially stacking up, prolonging your anxiety. So this seemingly small detail is incredibly important for the efficiency and overall cost-effectiveness of your application. Pay attention here. Now, the correct mailing address depends entirely on how you are filing Form 9465. There are two main scenarios. Scenario 1. If you are filing Form 9465 together with your annual tax return, like your Form 9465, you should physically attach Form 9465 to the front of your tax return. Then, you simply send your entire tax return package return plus Form 9465 to the address provided in your tax return instruction booklet for where that return should be filed. Easy enough.
Okay, so if filing with a return, just send it all together to the normal return address.
Correct. That's the most common situation if you realize you need a payment plan at the same time you're filing your annual return. Scenario 2, however, is if you have already filed your tax return, or if you are filing Form 9465 in response to a notice you received from the IRS about a balance due. In this situation, you will be sending Form 9465 by itself, not with a full tax return. And when filing it by itself, you need to send it to a specific Internal Revenue Service Center address. This is where it gets a little tricky.
Why tricky? Isn't there just one address?
Nope. The correct service center address varies significantly based on the state you live in. And it can also depend on whether you filed certain schedules with your Form 1040 or 1040 SR for the tax years in question. Specifically, Schedule C, Profit or Loss from Business, Schedule E, Supplemental Income and Loss, or Schedule F, Profit or Loss from Farming. Filing those can change the mailing address.
Wow, okay, so it's not a one-size-fits-all mailing address if you're sending the form in separately. You really need to pay close attention to where you live and what kind of income you reported on the related return. This sounds like a classic read the instructions carefully moment that could save you a lot of headache and delay.
Exactly. It's crucial. For instance, depending on your state and whether you filed those specific schedules, the correct address could be an IRS center in Andover, Massachusetts, or Kansas City, Missouri, or Memphis, Tennessee, or Austin, Texas, or Ogden, Utah, or Fresno, California, among others. They are all different. The key takeaway for you, the listener, is to always check the specific current instructions for Form 9465 to find the exact mailing address that applies to your specific circumstances when filing the form by itself. Don't guess, don't assume based on where you sent your return last year. Look it up in the Form 9465 instructions for that filing year. That small step ensures your carefully crafted payment plan request actually gets to the right place promptly and starts the review process without unnecessary delays. And just to tie it all back one last time to the broader goal of minimizing costs, the instructions themselves offer this final piece of general practical advice. To limit interest and penalty charges, file your return on time and pay as much of the tax as possible with your return or notice.
Back to that core idea.
Yes. It's the ultimate tax-saving insight when dealing with tax debt. Reducing that principal balance as early and as much as possible fundamentally reduces the accumulating costs over time. That applies whether you're setting up an installment agreement or using any other method to resolve the debt. Pay it down faster to pay less overall.
Wow, okay. We have really taken a deep dive into Form 9465 today, haven't we? We've gone all the way from understanding what an installment agreement even is and when it's the right tool, to exploring those smart alternatives and critical fee savings. Then breaking down the form itself piece by piece so you know exactly what to consider and where those strategic choices lie. And finally, really understanding your rights and responsibilities throughout the entire process, from application to completion or even potential default. It feels like we've genuinely demystified what can be a really intimidating topic for a lot of people.
Indeed. I think the real aha moment here isn't just about, the mechanics of how to fill out a government form. It's about realizing that even when you're facing the stress of tax debt, there are structured, manageable, and official paths forward provided by the IRS itself. It really underscores the power of being informed and proactive in managing your financial obligations, and how that informed action, like choosing the right application method or payment type, can directly translate into minimizing the financial burden and saving you real money.
It really does. It transforms what can feel like an overwhelming dead-end situation into something navigable and manageable. And that feeling alone is incredibly empowering. And that brings us actually to our provocative thought for today, something to maybe chew on after we sign off. In a world that feels like it's full of increasing financial complexity, how does understanding these detailed, seemingly niche bureaucratic processes like navigating an IRS installment agreement form, how does that understanding empower individuals, not just with their taxes, but maybe in navigating any complex system, whether it's healthcare, insurance, or anything else? How does it help transform that initial fear or confusion into actionable knowledge and confidence?
That's a great question to ponder. Knowing the rules of engagement, the available options, and your rights within any large institution or system, it really can fundamentally shift your perspective and ultimately your outcomes. It turns what might seem like an insurmountable obstacle into just a series of defined steps you can confidently take. Knowledge is leverage.
Absolutely. Well put. Thank you so much for joining us on this deep dive today. We sincerely hope this has given you a clear, practical roadmap should you ever find yourself needing to navigate an IRS installment agreement using Form 9465. Keep learning, keep asking questions, and we'll see you next time for another deep dive.